Buying call options to take advantage of upward moves. Hi, I'm Dave Whitmore, Senior Strategist at E-Trade. Thanks for joining. Buying a call option in anticipation of a stock rising is a speculative trade. And when it comes to options, there are a number of moving parts, shall we say, that make the approach a little more involved. So let's explore those. First, we're going to start off with a review of some of the essential elements and facts about options. Then we'll start with what I'll suggest is first things first, and that is what are you thinking about the underlying stock? Once we've covered that, we'll talk about selecting the strike price and the expiration for our option trade, and then we'll work through a hypothetical set of scenarios. So first, let's review a few facts. We have a thing called an option. When you buy an option, you then own it, and you are said to be long that option. The other side of your trade is someone who sells you that option. We call that the writer of an option. And when they have written an option, when they have sold an option that they didn't own, they are said to be short that option. An option is a contract that is traded in the open market. It's traded on exchanges, not unlike the New York Stock Exchange. And the process is all cleared, the idea of exercising this contract, through what's called the Options Clearing Corporation, a centralized clearinghouse. So no option owner needs to or ever knows the identity of the other side of the trade. It's not necessary. And in fact, that obligation can move from one holder to another. So the owner's connection to this idea of a contract is purely electronic. When you buy an option, you have to pay for it. You pay what's called the premium. The premium is the market price of the option. When you pay that premium, it is collected or received by the person who writes the option, because remember, they sell that option, so they receive the proceeds. When you own an option, you have a right. When you have a right to do something, you may, if you wish, exercise that right. You don't have to. The other side of the right is an obligation. And the writer, W-R-I-T-E-R, of an option has the obligation to carry out whatever will happen if the owner exercises their option. And we call that being assigned on an exercise. So if an owner of an option exercises their right, some writer of the option is going to be assigned that and have to carry out the obligation. And then finally, there are call options and put options. Call options give the owner of the option the right to buy the underlying stock. The writer of a call option has an obligation to sell. A put option gives the owner the right to sell, and the put writer the obligation to buy. All right, let's talk about the value or the price of an option. What is an option worth? So we've got this market price, what we call the premium. An option price consists of two different values, the intrinsic value and the time value, which sometimes is also called the extrinsic value. The intrinsic value is very simple. It's just arithmetic. It's the difference between the stock price and the strike price. Time value is a little more involved. The two major drivers of the time value of an option are how much time until expiration and how volatile is the stock. If you have two stocks, the same price, and we're looking at an option with the same amount of time to expiration, but one is more volatile than the other, the options on the more volatile stock will generally be higher priced because there will be more time value in the option. Two other components that also contribute to the time value are whatever the prevailing rate of interest is in the market, extremely low right now, and then whether or not this stock pays a dividend and how much. These factors are embedded into that time value number, but they're not very dynamic, so it's not really an input from a trader's standpoint, not like the time to expiration and volatility and intrinsic value are. So the pros and the cons, then, of using a call option to speculate on a move in an underlying stock. Well, the first pro is you get leverage. And this is inherent to options generally. You can control more with less money. You can speculate with a smaller amount and control more shares than buying the shares outright. When you buy an option, you have defined risk. Your maximum loss is very simply what you pay for it. You also have a lot of choice. Important choice, too. Choices between how much risk do you want to take on the trade? How much reward do you want to reach for on the trade? And then finally, what are the probabilities of various outcomes? On the other side of the ledger, the con side, well, when you own an option, the biggest issue that you have to face is this time premium. Because remember, you're paying more for the option than its intrinsic value because there's that time component. Eventually, time is going to be down to 0 time left, at which time the time premium is going to be 0. So this idea is called time decay, and it's an inherent headwind for an option owner. You have a limited holding period. You have to be right not just in a price move, but in time. This is something that we'll see in our hypothetical scenarios coming up. You face the possibility of your option expiring worthless. And one more thing, when you own an option, you don't get any dividends, you can't vote, and so on. All right, so we've reviewed the basic facts and essential elements of options, and we've gone through a little bit of a pros and cons. Let's now turn our attention to the stock, because this is where it starts, right? We have to have an idea on a stock that would prompt us to want to go in and buy a call option. So let's work it through. Here's our intrepid hero pondering his trade in XYZ, and he says, I really think this stock is going higher because, well, I guess the question is why? And this is, you have to interview yourself here. Do you think it's going higher because of something fundamental, like its earnings or a product announcement? Or are you looking at a chart? Whatever your answer is an important guide to how you plan the strategy. So, for instance, if your idea is, well, the stock reports earnings next month, and I got a feeling about those earnings. Well, in this case, this is a very suitable approach to thinking about using a call option to speculate on the stock. And there's many other ways. You've got a month of time available. You can use a simple long call. Even within that choice, we've got buying an in the money versus an out of the money. You could also use a bull call spread. You could also use a variety of other more exotic strategies. But in this case, you've got a time period. You know that there's an earnings date you're looking for. And now you have a variety of ways to fashion a trade around that. What if your idea is, well, the stock reports earnings this week. So let's say it's a Monday and you know that your stock XYZ is going to report earnings on Thursday. Well, that also lends itself to an option strategy, but one thing that's really important, and you'll notice that I'm using yellow here instead of green, is you are riding right into the face of potentially extreme volatility. Just know that. It's all I'm saying. I mean, you may be seeking that volatility. One important thing to be aware of is that what is often the case here is what's called a volatility crush. And that is, volatility is high leading up to the earnings date. And then in the aftermath of the announcement, the volatility declines substantially. And that affects options prices. And sometimes you can get some options price outcomes that might not seem to make sense. So, two aspects to that. What about sort of you just really like the stock and you think its earnings are going to grow for years? This is sort of the core fundamental characteristic of a stock. Well, if that's your thinking, I'm going to suggest that maybe an option trade isn't really what you want to use. Because of this time window that's so important for us, having a long-term fundamental case for a stock doesn't necessarily help us if we're dealing with a 6-week period. So if that's what you think, well, maybe just buying the stock is a better idea. There are long-term options. They used to be called leaps. But let's just make this point. There are options out there that have expiration dates that might be a year or two from now. Just know that while they are there, they're very expensive. So it might not be the kind of a trade that you were imagining that a lot of option traders are attracted to. Well, what if it's chart analysis? What if it's technical analysis? So one would be the stock has strong momentum, meaning it's rising strongly and rapidly. Can you say hello Tesla back in that period? Well, this is certainly a possible way to jump on a stock and use a call option. Just realize that in this situation, those calls are going to be expensive. They're going to have probably a lot of time premium in them, and they will also be very volatile. Another chart view might be that the stock, and if you've been on some of our webinars, you might know we talk about this a lot. What if the stock is at what you think of as support, but it's in an uptrend? Well, that's an interesting situation. There might not be this enthusiasm about it, so the call options may not have as much time premium in them. It also might be the case that you need more time for your hypothesis to play out. On the other extreme is the stock is oversold, meaning the stock has been tanking and I just know it has to bounce. Okay, that's also a potentially suitable backdrop for a call. But the important thing to remember about this is sort of three eyes. First of all, you're making a counter trend trade. You are swimming against the tide. Furthermore, oversold conditions can persist for a long time. So it's not necessarily a timing signal, just becoming oversold. The cliche that has always been used is that trying to buy a stock because it's oversold like this can be tantamount to trying to catch a falling knife. If you catch it perfectly, it'd be a good trade. You can also get hurt by it. So that's sort of just a way for you to apply sort of a framework of what is it you are thinking about this stock. Because the more you flesh out that story, the better you'll be able to go through the choices of time to expiration, strike prices, and probabilities. So let's do a chart example. Here is a real stock, Micron Technology. This is a daily chart that goes back to May of 2018. And it gives me an example of how you might use a chart to come up with some important price points that can be very helpful in planning an option trade. So first off, and by the way, if you're not familiar with technical analysis, we have numerous webinars in our replay area where you can go in and get the essential relationships that I'm going to refer to here. But a chart user would first observe that we've got higher lows here. Higher lows are one of the hallmarks of an uptrend. So this is the very beginning of the potential of an uptrend move. The chartist might also observe this moving average cross, and when the faster 50-day moving average crosses up and through the slower 200-day moving average, that is a signal of a trend move in that direction. So when we put that evidence together, we conclude, okay, we've got a stock in an uptrend. We think we want to speculate on further prices. So now, the other important information that this chart gives us is some logical price targets. The first of which is simply to return to this previous intermediate high here. The stock's 43.50, 43.60. So a move to 48.70 for some traders, and certainly for an option, that's enough of a price move to make a nice trade. We could also be a little more aggressive and potentially trade to reach the previous high, the previous all-time high at 64.66. That's a more demanding price target, but it's a logical one. And there's one other way you could come up with a price target here, and maybe this is a little bit arcane, but this formation here is called a triangle. And when you have a triangle, one of the techniques is to use the base of the triangle as a price target for a breakout. So we project from the breakout, and that would bring the stock to 53 if that piece of analysis held true. So we've got three possible price targets. The recent high at 48.70 would be our target number one. The measured move from the triangle getting to 53, and the aggressive reach to reach that 2018 high at 64.66. So we've got a stock, it's 43.60. We've got three possible price targets, 48.70, 53, and 64.66. Okay, that's step one. What about time? So this is a more subjective notion here, and it gets a little bit, we're sketching here. We're not taking photography, if I can use that analogy. So I've got the two price targets in there. So looking at the way this stock has moved in the past, how much time would be rational to reach one or both of those price targets? So one thing to notice is take a look at rallies in the stock. And numerous times we get a fairly sharp rise at a pronounced angle up. So we could certainly say, well, that would be a logical angle of ascent. I'll use that phrase, angle of ascent. But we could also observe that sometimes the trends that it has are more modest and grind out the move over a longer period of time. This is now an area where you're going to start to make a choice. Do you want to trade for the quick pop and expect a relatively short holding period? Or do you want to get aboard this stock and potentially hold the option for a few months, meaning you're going to hold it through some ups and downs? There's no right answer here. But as we work through this, you'll see that we can introduce some notions of probability as well. So, how long? Well, if we were going to be really aggressive, we might say, it might only take me 10, 15 days to get to our price targets. If we were going to be more conservative, we would allow for more time and possibly allow that it might take 30 days or 40 days for the stock to get to our price. With that in mind, we can now turn our attention to what's on the menu: strike prices and expirations. So this comes to us in an options chain. This is our menu. This is where we choose our option trade. The expiration dates that are available are along the top, and you'll see that two of those have check marks. Those are the two that I have displayed. One that has 52 days to expiration and one that has 80 days to expiration. One important note here: these expiration dates are determined by the options exchanges, not by E-Trade and not by the company, meaning Micron. It is the exchanges that decide what strike prices they will offer and what months they will offer. So you open up the menu and you see what's available. The layout is calls on the left and puts on the right, and then the various strike prices down the center. In this case, you can see that strike prices are in 1 point increments. Sometimes you'll see 50-cent increments. Sometimes you'll see 5-point increments. Again, all of that is a result of decisions that the options exchanges make. So there's a rule of thumb that traders should consider twice the amount of time in their option selection than what their target scenario envisions. So if you imagined a 40-day period for your stock to get to it, then it would point to looking for options that have 80 days of life. If you were thinking 20 days to get there, you probably want to buy at least 40 days. These are rules of thumb. These are basic guidelines. You can use them up and down, but just remember that the shorter the amount of time that you buy, the more you are faced with the problem of that time decay issue. So let's talk about that. Here is a chart, and I want to explain what it shows and then explain what it illustrates. This is a chart showing the theoretical price of an option at various times to expiration. Now look in the upper right corner. What we have done here is said, if we have a stock that is a $50 stock and it has 35% volatility and prevailing interest rates are 2% and there's no dividend in the stock, in looking at a $50 strike price option, the first bar tells us that if that option has 125 days till expiration, the theoretical value of that option is $4.25. Now remember, the stock is 50 and we're looking at a 50 strike price. So that 425 is all-time premium. If I compare that to the same data, but now with only 115 days to expiration, the value of the option is down close to $4. I think it's $4.05. So therefore, it's worth 4% less because 10 days have gone by. And this illustrates what happens with time decay. Now, let's follow the chart through. Because if we move from 95 days to expiration to 85 days to expiration, the theoretical value of the option is now 6% lower than it was 10 days previous. So in this 10-day period, the option loses 6% of its value. In the first 10-day period, the option loses 4% of its value. I think you can maybe see the relationship that this is illustrating. From 65 days to 55 days, 8% of the option dissipates in time decay. From 35 to 25 days, 16% of the option decays away. From 15 days to 5 days, 42% of the value of the option will disappear. And so this is why we say that in this last 30 days of life, time decay becomes pronounced. And so as an option holder, we can add one more element to this idea of how much time we're picking. So let's start with 2 times what we think our time frame requires. And then let's also try to make sure that we don't continue to hold the option into those last 30 days. This is a really important point. We talk about options all the time as comparing them at expiration to see what the value is and what the leverage is. But know that most option traders don't hold the option till expiration. And that's what our scenarios are going to help us illustrate. All right, so let's do some strike price comparisons. So here we are back at the chain, and what I'm going to do is examine 2 different strike prices in 2 different expirations. The first one is a 45. Now remember, the stock is 43.60. So this is at the money, just a little bit out of the money. The other one is the 50. 50s are well out of the money, over 5 points out of the money. And there are the option prices. But I want to now turn to probability. So one of the columns that you can add to your option chains is a probability estimate. And so I'm highlighting right here that you can slide, quote, the puts out of the way and make your display show more columns for your chain. And so now we're just looking at calls. And what you will see is we've got this column here, prob ITM EXP ATMIV. What? Okay, so that means the probability that the option will be in the money at expiration, and that probability is calculated using the implied volatilities of the at-the-money options. At this stage, we don't really need to get into a big discussion about implied volatility and the importance of the at-the-monies. Let's just say this is a estimate of the probability that the option will be in the money at expiration, and you can see the figures there. So let's compare our options and talk a little bit more about the probability idea. So here are the option prices for the 4 options. The October 45 is $2.65, the October 49 is $1.03, the November 45 is $3.40, and the November 49 is $1.58. And here are the probability of being in the money at expiration. You can see that the lower strike, the one closer to the money, has the higher probability. Makes sense, right? But I want you to think about this a little bit differently, and let's think about what this means. Probability that it's in the money. So in the money just means that the stock is above the strike price. It could be above the strike price by a penny. So the 45 call, if the stock was 45.01, it's in the money. Does that mean it's profitable? No, it does not. So in fact, I will suggest that a better way to think about this figure is that the inverse of it, or I should say the reciprocal of it, is the probability that the option will be worthless at expiration, meaning at 45 or lower. So if we take the 100% minus these numbers, what this now says is that the October 45 has a 58% chance of being worthless. The October 49, a 74% chance of being worthless. So that just, I think, puts more starkly the additional risk that we get with out-of-the-money options. A really important thing to note. Yes, that October 49 is just a mere $1.03, but there's a 3 out of 4 chance that it expires worthless. So let's compare the outcomes in another way. And this is now to take it all the way to expiration. And this is just to show the leverage that is present in an option trade and to compare these two different strike prices. So the first cell we want to reveal is if the stock is 49 at expiration, the option is worth $4. It's worth exactly its intrinsic value. We have the right to buy it at 45. The stock's 49. That's $4 value. We made 51% on our trade. We bought something at 265. It's worth 51%. The rest of the values are fairly straightforward. You can see that the stock's 50, the 45 call is worth $5. If the stock's 51, the 45 call is worth $6, and so on. And there are the percentages. This illustrates the leverage that we get from an option trade. What about the 49s? Well, the first one to stop at is the 49. I'm sorry, what about the 50s? If the stock is 49, the right to buy it at 50 when there is no time left is worth 0. There's no time premium, there's no intrinsic value, 100% loss. Same thing at 50. At 50, there's no intrinsic value. It's the right to buy it at 50, but it's 50 in the open market, so the option has no value. It's a 100% loss. At 51, we're down, but just barely. We're down that 3 cents. We're down 3%. The stock is 51. It's a 50 strike price. It has $1 of intrinsic value. Therefore, we bought it at 103. We're down 3%. And then at higher prices is where we start to see the trade start to pay off. But you'll notice that it lags the 45, at least at these prices. It would pass it as we went higher and higher. If the stock was at 60, the percentage return on the 50 would be greater. But so those are two ways for us to think about selecting our strike price, our expiration, etc. There's no right answer here, and I think that's one important thing to recognize. It's more like, what are you comfortable with? Do you want to play a high reward, low win percentage game, or do you want to play a game where you have a high win percentage but make small amounts when you win? That's the trade-off. And because of the wide menu choices with options, you can pretty much find a spot all along that sort of continuum of trade-off. So, how to think about this? Well, first thing, what's your price target? That's going to clearly point to what are reasonable strike prices. In our example here, nothing in our work would have pointed to trying to buy these 75 calls, because we're just looking for a trade for the stock to move to 5, 6, 7, 8 points. How much time is necessary? Using a chart is a reasonable way to do that, to analyze that. And then think about probabilities. Think about the probabilities of the various candidates that you've raised. The last thing to check, and we haven't discussed it here, but options can sometimes be illiquid. So focusing on widely held stocks, frequently traded stocks, is going to find you in markets where you're going to find good liquid options to trade. Thinly traded stocks sometimes have very thinly traded options, and so we want to pay attention to liquidity. All right, let's do a scenario. What do you say? Let's do the setup. So our stock is XYZ. It's 43.60. We've decided we want to buy a 45 strike call. The market price is $2.65, and it has 52 days to expiration. Market value of the option is $265. There is no intrinsic value in this option because it's out of the money. Therefore, the price is all time value, $265 of time value. Scenario number 1. The stock is 48 in 1 week. So it's up $4.40. 1 week has gone by. There is now 45 days to expiration. So what's this option likely to be worth? Well, first off, we'll start with the intrinsic value. It has $3 of intrinsic value. It's because it gives us the right to buy the stock at 45, and the stock is currently 48. So it is $3 in the money. It has $3 of intrinsic value. What about time value? Well, time has passed. A week has passed. A week ago, the time value was $2.65. I'm estimating here. Notice my question mark. But probably the time value is a little lower than it was because time has passed. I don't have an assumption about volatility, but usually with rising prices, volatility is declining. So if we say, well, 225 in time value, well, that means that probably the market value of the option would be in the 525 range. So how does our trade work out? Well, we're up 260. We paid 265. It's 525, so we're up 260. So if we sold the call right now, we would take in $525. It cost us $265, therefore we made $260. And now I'm going to speak to the asterisk here. There is a small per contract fee in option trades. It's 65 cents per contract. So in this case, because we were using one contract and we assumed that you bought it and then sold it, you would incur $1.30 contract charge there. So your actual net gain would be $258.70, which would be a return of 98% on a 10% move in the stock. And there's the leverage that option traders seek. A 10% move in the stock created a double, essentially, in our trade. All right, scenario number 2. Stock is $48 the next day. Well, that's very interesting. So here, the stock has jumped immediately and substantially So instead of 52 days to expiration, we have 51 days to expiration. So almost the same amount of time. So let's look at our option. The intrinsic value of that call is $3, just like it was previously. Remember, intrinsic value is just the difference between the strike and the stock. But what about time value? Well, I'm going to suggest here that time value might actually have expanded in this situation because this is a really big jump that occurred in one day. So with 51 days and higher volatility, probably because of this big jump, I'm going to suggest that the option might be trading in the $6 range at this point, which would give us a gain of $3.35 on the option. Working through the dollars, now, because the trade happened immediately, we have 126% return instead of 98%, because our price move happened with less time disappearing. And that is a huge lesson in option trading. You want the option trade, when you're long an option, to work out as quickly as possible. Okay, so what if we were right about 48, but it took all the way to expiration to get there? So the stock's still up 440, it's still up 10%. But what has happened to our option? Well, the intrinsic value is still $3. Remember, that's just the 48 minus 45. But what about time value? None. So what about the market value of the call? So first off, let's talk about this time value and when we say at expiration. I am envisioning that this is expiration day. And during the trading day, there are still people trading this option, even though it's going to expire at the end of the day. So there will be a market for the option. There's not going to be any time value because it's about to expire or not very much at all. So if the if the intrinsic value is $3, what is going to be the market value? Now, I am imagining, and let's say this has now gotten into the last 30 minutes of the day. So it's 3:30 Eastern time, the close is approaching, and you're looking at this option. And you can see it's got $3 of intrinsic value, and then you look at the option chain and you see that it's 290 bid. So why is that? Well, there probably aren't very many speculators like you and I out there wanting to buy this option with 20 minutes to go. That bid is coming from a market maker, a professional trader who is willing to buy your option. But he's willing to buy it at a discount because a market maker is able to capture that 10 cents there in an immediate risk-free trade. They're able to, because they're professional trading platforms, that market maker is able to buy the option from you for $290, exercise it immediately, and sell the stock at 48 and capture the intrinsic value. He provides a service of liquidity available for you, and for that, that's how that market maker can make money, and it's why he would be willing to bid on it. So at any rate, you bought this at $265. Let's say you sold it at $290. You made $25. You got to pay that contract fee. You made a little less than 9%, even though the stock moved 10%. And it's a simple reason. It's because you had to hold all the way to expiration. The move took too long. Recognize, though, that this is not your only choice here. You could exercise the call, and that would mean you would then be buying the stock at 45. You would have to have $4,500 in the account to do so, but then you would simply be long the stock that is currently 48. This probably is happening on a Friday, so it just means coming into Monday, you'll be an owner of XYZ at 45, and it's 48. Now, if it opens at 46 on Monday, well, then you're only up 1 point. So in other words, if you choose to exercise, you're now at risk of owning the stock and whatever subsequent stock price moves are. The other strategy that is sometimes employed by an option trader is to roll the option. This would be for someone who said, I've been right on this stock and I still think it's going higher. I know my expiration is coming up, but rolling means I'm going to sell this option for whatever I can get for it, $290, and then I'm going to use that money to buy another option. And that other option might be at a different strike price, or it might be at a different expiration. Well, certainly it will be at a different expiration. What if the stock is 44 and 2 weeks have transpired? So this is sort of the call buyers, I'm not going to say worst scenario, but it's not a very good one. The stock has kind of moved up a little bit. Certainly hasn't tanked or gone down, but 2 weeks of time have gone by. So now we have 38 days to expiration. So let's go through our values. What's the intrinsic value of the call? 0. There's no time premium. There's no intrinsic value. The stock is 44. It's a 45 strike. Is there time value in the option? Yes, there is. It's going to be meaningfully less. Let's say it's $1.50. Okay, so that would mean that the market value is $1.50, and if we would then be down $1.15 on the option that we bought at $2.65. And here are the dollar outcomes. And so, while I say this is a really uncomfortable situation for an option trader, here we have a situation where the stock's actually risen 1%, but we lost half of our trade. And that, again, goes back to this idea that it's the combination of the price move and the time period that is so vital in the outcome of the trade. Scenario 5. The stock is at 45.01 at expiration. Seems like a peculiar price for me to bring up, but it's an important price, an important discussion. So in this scenario, the stock has risen. It's up $1.41. It's right at our strike price. So what's going to be going on here? One thing to understand is very often the stock might be ticking right around a strike price as the close comes up. If the stock closed at 45 even, it would expire worthless. If it's above 45 at all, there's an issue with what's called automatic exercise. So first, let's go through our numbers. The intrinsic value of the call is 1 cent. The time value is down to 0. Therefore, the market value of the call, there's not going to be a bid. If you were to look at the option chain for this in the last few minutes, you would see no bid, and it would probably be offered for sale for a nickel in case anybody was going in there to buy that. So you lost the 265. You're down 100%, even though the stock's up 3%. And so the reason I brought up the 01 is because of this idea of automatic exercise. We spoke about the OCC earlier, the Options Clearing Corporation. The Options Clearing Corporation will automatically exercise any option that's in the money at all. And 1 penny in the money is sufficiently for that exercise. If your account can handle it, if you have $4,500 in it, the exercise will occur and you'll own the stock. If you wanted to own the stock, that's great. But if you didn't want to own the stock, recognize that you're now at risk. So in this situation, first off, pay attention on expiration date if you're still holding an option. And if it's anywhere near close, recognize that if it closes in the money at all, you may be an owner of the stock. But second of all, and this goes back to what I said before, most option traders don't hold options all the way to expiration. So the more prudent strategy is to trade out of an option before you get into that last period of extremely declining time value. If it does happen to close at a price like this, 45.01, 45.02, and you've noticed it, and you don't want that exercise to occur, you need to give us a call and tell us, don't exercise that option. Last scenario, stock's down. You were wrong. It's down 860. It just drifted all the way down throughout the entire life. It's 0, it's 0, it's 0. We had 100% loss. But there's something important to point out. Had I bought the stock instead of the option, I'd be down a lot more. I'd be down $860 compared to a loss of just $266.30. So this is a very important notion that the limited risk of an option can be better than an outright stock trade in certain circumstances. Hey, let's wrap it up. Option traders should consider several moving parts when planning a trade. You got to start with a target price for the stock. Allow a rational period of time to reach your target price. Think about probability when you're looking for your strike prices and your expiration dates. And then finally, make sure to check that liquidity and be leery of trading low liquidity options. Thanks for listening, folks. Good luck in the markets out there. Take care.